Another way to finance your company is issuing some stock. So stock, major means of equity financing. You look at big companies, your Apple, your GE, HP. You know, there's a lot of stock out there. They sold a lot of stock. Stock's worth a lot of money. You know, in stock, you typically buy shares. So you go out in the stock market and you buy 100 shares of Apple. And therefore, you own 100 shares in some portion of Apple. So shares of stock can be put into 3 different buckets. So we have authorized. So that's the total number of shares we're allowed to issue. So if we have, say we're Corporation XYZ, we're authorized to issue 100,000 shares of stock. And we actually issued 80,000 shares of stock to stockholders that we sold. So we could sell 100,000 shares of stock. We've sold 80,000 shares of stock, and that's the amount shares issued. And then the stocks actually in the hands of stockholders is the stock outstanding. So shares of stock issued without assigning a monetary amount. Because when you buy shares of stock, you're buying it based on the market price from the Wall Street Journal or TD Ameritrade. So what we have is this monetary value called par value. So par value would be, say, $1 par value. But that doesn't mean you're buying it for $1. You're buying it whatever you see in the Wall Street Journal or Ameritrade. And there's also an idea called no par common stock, which is very uncommon. And then there's legal capital, a minimum stockholder contribution required by some states. So when you own stock, you have the right and vote to matters concerning the corporation, but the amount of votes you get is proportionate to how much stock you own. So if there's 1 million shares of stock for a company and you own 5 shares, yeah, you can vote, but your vote probably won't mean very much. But if there's 1 million shares outstanding and you own 400,000 of them, yeah, then your vote means quite a bit. You own 40% of the company. You also have a right to share in distributions of earnings. So when the company declares what's called a dividend, where they pay their stockholders, so if you own 40% of the shares of a company and they issue a $1 million stock dividend, that means you get 400,000 of it. So you share in the distributions of earnings, which is called dividends. And then you have the right to share in assets on liquidation. So if the company goes belly up and goes bankrupt, if you own 40% of the company, when they liquidate, you get 40% of the value of the assets they sold that go to common stockholders. So there's 2 different kinds of stock out there. There's common stock and preferred stock. Typically what you see in the Wall Street Journal or Ameritrade, that's typically called common stock. So each share is equal. So 1 share of common stock across the board is all the same. And then each share you get voting rights. So if you own 40% of the shares outstanding of a company, you have 40% of the voting rights. Preferred stock, you have preference rights over common stock. And then you get a dividend on preferred stock. The big thing with preferred stock is you get a dividend. So if you buy 10 shares of common stock, you're not guaranteed a dividend if the company doesn't declare one. So if you can own stock in Microsoft, they didn't declare a dividend for over 20 years. So you didn't get anything back out of the company. The way you made money off shares of Microsoft stock was selling it, buying and selling it for profit. When you own preferred stock, you buy it with the intention of getting a dividend. So when you own preferred stock, you get, say, a 2% dividend. So, how does the stock price get determined? And this is something that a lot of research is done. If anybody really knew this, you would be rich. But a couple things: the financial condition, earnings, and dividend record of the company. So if a company is not doing real well financially, the stock's not going to sell for very much. But if the company's regularly beating its beating its targets and doing great, it's going to sell for a little bit more. Expectations of earning power. So, say a pharmaceutical company is doing okay, but all of a sudden news breaks that they found a patent to cure some kind of rare disease. Well, the expectations of investors is going to go up because they haven't sold any of that drug yet, but the expectation is that they're going to, and they're going to put up big numbers in the future. And then general economic conditions and prospects. So let's just use the housing market, for instance. A company could be okay, but the industry they're in could be really struggling. So a few years ago, if you were looking at companies in the housing market, you weren't very excited about them because the industry itself was in bad shape. Or if something happened to the retail industry in general, you would be a little skeptical about companies like Walmart. So let's look at an example of issuing some stock. So assume that we issue 2,000 shares of dollar par value common stock for $55 a share. So remember, par value is just an arbitrary number that we have to put into our books to have a value of stock. And typically companies use $1 because it's easy to calculate. So the issuance of stock. So we have cash coming in the door of $110,000. That's 2,000 shares times $55 a share. So cash comes in to $110,000. Common stock, we're going to increase stockholders' equity by $2,000. The common stock piece of that entry is 2,000 shares times $1 par value gets you the $2,000. Then the paid in capital in excess of par is the 2,000 shares times $54, paid in capital in excess of par. How much was paid in excess of par? 55 minus 1, $54. So the amount that you sell the common stock for above par is $54 times 2,000 shares gets you to $108,000. And that also increases stockholders' equity. And you can also buy some stock back, which is called treasury stock. So we issued some stock 5 years ago, and now we've bought it back. And then the balance of that stock at year end is a reduction in stockholders'